Welcome to another episode of the All Tense Podcast. I'm your co-host, Josh West. With me, as always, Clay Harrison. Today, Clay, we're switching it up with a new episode theme that we like to call Outside the Guide, where Clay and I are going to dig into our experience as business owners and help others understand things that are outside of EOS tools and disciplines. And one of the things that we often hear from our clients is they wish that a lot of their leadership and mid-management had a bit more financial acumen. So we're going to kick this off with a series around financial statements. And first, Clay, I'd like for you to just cover off a few caveats and disclaimers for our listeners.
Yeah, well, it's what our clients wish they knew more of, or the thing that we call each other after a session and be like, I can't believe my client didn't know this, or like we just finished a session where a client kind of didn't quite understand X, Y, or Z. So outside the guide is kind of like the things that we see, like entrepreneurs struggling with, things that we've got direct experience with. Part of when we talk about our roles in the room, we teach inside the guide, we facilitate great discussions, but then we coach. And so maybe this one is also like a little bit of the coaching part of it, right? Where it's kind of like, here's our, anyway, disclaimer on this specific series is that neither of us are financial advisors or professionals in any way. So please don't do anything that we tell you to do and run it by your person first. There's probably someone in your life that you trust, have known for a while, who's very good, maybe even certified or has done specific training in this kind of stuff. And so think of this as like a place to figure out some questions to ask, not a place to find answers. Yeah?
Yeah, to put a fine point on it, neither Clay nor I are CPAs. We do know how to read financial statements, and we have basic understanding of GAAP, accounting principles, but no, do not take this as we are your CPA.
Correct.
Yeah. And, you know, in going through the statements, I figured we'd start with the one that perhaps people are most familiar with is the income statement, otherwise known as profit and loss, or what people just kind of casually call the P&L. Clay, what's a P&L?
Well, I think this is the one that everyone like kind of has a general kind of, this is the one that most people like probably print first when they're getting their numbers ready. Right. And, you know, we could spend hours and hours boringly talking about what a P&L is, but essentially it's like, how much money that came in? What's the revenue? How much did it cost to deliver it? How much did it cost to sell it? And that gives you a profitability number. And there's all sorts of different words and things in there that help you understand it. But essentially, how much money did you get? How much did it cost to make it? How much did it cost to sell it? And that turns into profit. The middle number is gross profit, right? So revenue minus cost of goods is gross profit minus cost of sales is net profit. And those are kind of like the 5 numbers that we look for. When you print it out of QuickBooks, though, you get a 40-page spreadsheet. And so the thing that often happens for me in session room, Josh, and I'd be interested to know how your experience is I ask someone about how the quarter went, or, how does that compare to last year? And they pull out this 40-page spreadsheet, and it takes them it takes them 30 minutes to kind of pick out which row they want to look at, and 90% of the rows are less than $2. And it's just like, you know, it's just kind of like complicated. So when it comes to the P&L, I think everybody gets it. We have a great episode that's already out there about the 8 cash flow drivers, which we're going to talk about a cash flow statement in a minute. But one of the things that cash flow drivers tools helps you pinpoint is what are the most important numbers on that P&L. You don't need to know with a fine-tooth comb exactly every little account. I want you to know the ones that are the most important. And so that's the general introduction to the P&L, Josh. Like, first of all, if you make it too complicated, it's hard to find what you're looking for. Second of all, know what the most important numbers on that P&L are. And like, as a business owner, you should probably know them, not have to look them up generally. You know what I'm saying?
Absolutely. And, you know, one of the things we talk about in EOS, and particularly with all of the specific terms that we use in there, is creating a common language so that everybody knows exactly what everyone means when we say accountability chart or the model, etc. And accounting is not unlike that. And so the first thing that I see is amongst teams is people are kind of talking past each other, conflating terms that technically mean different things. And so I think the first thing is like, there's no other way around this. You just have to teach yourself what those specific words mean. Revenue is not profit, et cetera, right? So certainly when we're talking about the income statement, when someone uses the term top line, what they mean is revenue or sales. And I think also this is where it's an important point to make that for the rest of the series, Clay and I are going to assume that you as a listener are operating on an accrual basis and not a cash basis. And so that means that on the income statement, that revenue is recognized on that statement when you as the business have performed an action where you have a right to collect and someone has an obligation to pay. You may not have that money in the bank yet, but something's been sold and someone's been given an invoice. And so that's what we mean top line. Then as we move down the sheet, just to simplify it, Clay, you also kind of brought up, like, I see lots of things that might be $2 and, or $3 here. And really, to simplify it, we're talking about things that are material. And I think that is a generally accepted GAAP practice there, as well as just the materialism of it. And so when we talk about the cost of goods sold, or what many people refer to as COGS, what we're saying is what was all of the costs and labor to acquire those materials and prepare them for sale. So if you keep inventory at all, it goes into COGS, as well as any of that labor. So for example, if you have only a services business, and that service is the product, then the people who are performing that, their labor is also there. Anyone else who is in support of that drops down later, and that portion of payroll is under OPEX. So just to make that clear. And then, you got to the first thing that is easy for people to keep up with. And I find that most times when we talk about the profit number in sessions, a lot of people just use that gross margin or gross profit number, where it's simply what was net sales minus the cost of goods sold, rather than getting into any more complexity, and they try to keep a certain percentage there. What do you see?
Well, I actually just want to make sure we're on the same you kind of walked us through revenue, which some people refer to top line or sales. Then you refer to cost of goods or COGS. The revenue number minus the dollar number gives you a gross profit number, which is a dollar number. Gross margin is generally shown as a percentage. They're both the same thing. It's just one is a dollar amount, one is a percentage. So again, on this train of like, let's talk about it the same way. Then the next thing below that, below gross profit, you called it OPEX, operating expenses. I earlier called it cost of sales. Sometimes people call it SG&A, sales general administrative, I think is the acronym there, not Shea Gildress Alexander MBA reference. Anyway, SG&A is the stuff that's below, quote unquote, below the line. Above the line is cost of goods. Below the gross profit line is cost of sales, is what I call it a lot. SG&A, operating expense, same thing. Yes, we're talking about the same thing there. I just want to calibrate.
100%.
And then cost, that gross profit dollar number minus SG&A, OPEX, cost of sales, whichever you want to call it, that turns into a net profit number. The net profit number can also be looked at from a margin perspective too. Again, dollars versus percentages. So just want to kind of clarify all of that. The thing I want to hit on for our people when they're talking about the P&L or the income statement, same thing, is that you mentioned we're working on an accrual basis. And I want to, or generally, most of the clients I'm working with, if they're not, they should be, and most of them are, right? And the reason we want to do that is because as you mature as an organization, it becomes, and we want to drive performance. I want to know how much stuff like actually costs to deliver, right? You mentioned the scenario where we deliver something, but haven't gotten paid yet, right? When we're doing accrual based accounting, we want to line that stuff up. I want to see how much it costs me to deliver this much revenue in the month so I get a true income statement. So it doesn't matter when I get paid or when I got paid, when the money hit the bank. None of that matters. What matters is how much did it cost to deliver this much revenue? And that's the only real way that we can start seeing if we're getting better, getting worse, doing like the point of the income statement. The point of all these financial reports are not to just generate spreadsheets and like check a box. I guess the point of all these reports is to manage the business. And so when you're managing the business, you said this before we started recording, Josh, but this thing about managing the business just by seeing how full the cookie jar is full of money. Like that works for a minute. It works if you're running the lemonade stand, right? But as you're maturing as a business and you truly want to start figuring out what works, what doesn't work, how to get better, how to get make little marginal incremental improvements in different parts of the business, you have to have a robust understanding of the financial health of the business. And one part of that is whether or not it's profitable. And that's what the income statement is showing you. I think as we grow up and mature in the business, the combination we're going to talk about in just a minute, cash flow statement. We're going to talk about after that balance sheet. The interplay of the three is the thing where you judge health. Income statement can show you that you're doing it profitably. Doesn't mean you won't run out of cash. Doesn't mean you don't owe people a ton of money and you're way over your skis. But the income statement is one of the good indicators of health that we want to make right. One other thing, so that's about accrual. The other thing I want to talk about on the income statements is that I can't tell you how many times I've been in it's more than I can count. It takes more than one hand to count the number of times this has happened where someone's like, yeah, I just put all my team members in SG&A or OPEX or whatever. And it's really just like hard costs, like cost of products. I put in COGS. And I think the way that you described it, Josh, is really good. But that idea that like for COGS, cost of goods, the thing that drives gross profit, everything it takes to deliver the service or product, whether that's materials, labor, if you operate a telemarketing business, the cost of the phone lines for those people doing the telemarket, right? You have to be cognizant of it. And like that can be one of those things. I think I have 2 points here on getting the P&L right. One of them is if you change it all the time, you lose a bunch of value because it's hard to compare one period to a previous period when you started measuring things differently. So like make an informed decision on how you want to organize your P&L and try to stick to it. And if you have to change it, my request will be that you take it back a couple years and change it for the past couple years so you can compare recent performance to what you're doing now in the new measurement way. And what I mean is like when I say I'm going to take this line item from my accounts and put it from SG&A and put it up into COGS, if you do that going forward only, you're kind of losing the perspective. Anyway, kind of a thing for me. Like, one, don't change it that often because it makes it impossible. And two, if you do, make it backwards so that you can be comparing same, apples to apples.
You are spot on. And, that's certainly something that I believe your CPA is going to agree with Clay on, that is that consistency is one of those principles. So choose a way and stick to that way, because also, again, as you said, comparing period to period is easy when we stay consistent. Otherwise, skews our insights and the results when we don't.
Right.
Go
ahead.
Go ahead.
Well, so that one is consistent. The other one is like one of the things that's really helpful, especially when it comes to income statements, is understanding industry standards and understanding your peers. And so like unless you're like breaking new ground is like no one's ever done this before, which probably isn't true. Talk to your peers. there's probably some sort of group within your industry that talks about how this is organized by most companies. And so not only do you want to be able to compare your results to the past, so the consistency across that, but also you want to be able to compare your results to industry peers. And so that means you probably need to take into account how other people in your industry are organizing their income statement. And same caveat, same advice, talk to your CPA, make sure you have someone who knows you and cares about you to give you good advice. But that's when you want to leverage these reports as a tool. One is comparing to the past. The other one is comparing to best in class in your industry. And you want to be able to do both. So think about how you simplify, organize, keep consistent with your income statement. And I just want to admit that I started this podcast before we started recording saying we got to move quick. And I just talked for like 4 minutes. So that's my bad.
It's okay. I think, we've covered this pretty well. I'll just give everyone just that high level summary. Again, when we use the words revenue or sales, this is when it's been made. We may not necessarily have gotten the money yet, but we've recognized that revenue in the income statement. Next, we're subtracting out cost of goods sold or COGS. What is all of the labor and money that we spent in order to produce that product for sale or deliver to service, which doesn't include the actual sale of it. So then we get to a gross profit number. From there, how much did it cost to support the business in that effort? What are all of those operating expenses? So all of the payroll that also supports those efforts, if we bought Post-it notes at the store, etc., all of that goes in there. Then we finally get to that operating income, or what a lot of people would call EBITDA. And then those last things that we need to subtract out prior to that are, if you have any interest income, there's taxes, depreciation, amortization, finally getting us to a profit number. And so then that is exactly as you mentioned earlier, what is the question that we're answering with this specific statement? And it is, are we operating the business profitably? Can it be possible for you to operating the business profitably, but also be insolvent? Yes. And we answer that in the next episode with cash flow statements. I think that'll do it for my nugget from there. I'd say also what you said about staying consistent, Clay, I think is an extremely important point that shouldn't be overlooked. Take them home.
Well, I think I have a nugget this time. I don't normally have a nugget, but you just reminded me, and this is a follow-on to my earlier statement, is that the reason that those numbers exist, the gross margin, the EBITDA margin, those things are so that you can kind of compare. If you just think about it, I want our listeners, because I think we kind of get wrapped up around using this word, making us, we know what the acronym EBITDA means. But what's the purpose of it? The purpose of it is to know how you're doing relative to other people who do what you do. So gross margin is how efficiently are you delivering the service. That's different. You might want to have like a really nice Class A office to do it from, and your buddy down the street who does the exact same business wants to do it out of his garage. And your gross margin, what it costs to deliver, should be pretty similar, but your EBITDA or net profit would probably look different because he's spending, or you're spending, I don't remember who in my example is who, but I'm spending $5,000 a month on office space and you're spending $0. That's cost of sales. I'm making some choices there. That gives us insight into what the difference is, right? Between the two businesses. We're delivering the services equally efficiently, but you're spending a bunch of money on something that I choose not to. That shows up in your net profit. And one of the reasons the EBITDA stands out is because how you finance that business can be different. Some people might be doing it straight from their bank account, and some people are taking out loans or whatever. And so gross margin helps you compare to other people and how efficiently you're working. EBITDA helps you determine like how profitable that business is, no matter how it gets financed. And then what's the number after? And then ultimately the income, the profit, bottom line profit, tells you whether or not that's making sense for you as a business, right? So like the whole point of this is not just to be able to throw a spreadsheet across the table and say, here's my P&L. That's like the first step that everybody can do. What I want our listeners to do is use that tool as a way to get better, to use it to manage the business, and you got to start with understanding. Anyway, so that was I'm not even sure that was a nugget. That was more like a chicken strip. But, whew, man. All right. Well, cool. Well, thanks everybody for listening. That was a fun episode on the income statement. Real nerding it out over here. It's pretty cool. So my name is Clay. His name is Josh. We're both EOS implementers, and we help business owners every day get the most out of their business so that can ultimately get the most out of their life. And we'd love to talk to you if this is a subject that you have more questions about or are struggling with. Please reach out to us. We're most easily found on LinkedIn. The podcast you can find anywhere, and we're so happy that you're listening. Please like, rate, share, do all the things that you do with the podcast, and we'll come back at you soon with an episode on cash flow statements. Whew, man, everybody's real eager for that one. So we'll talk to you soon. Thanks, Josh. Good job.
Bye, Clay.
Bye.